Hi everybody, this is Sean. Welcome to the fourth installment of our year-end newsletter talking about cleaning up your balance sheet. In the previous episodes, we talked about current assets like cash, accounts receivable, and inventory. And we also talked about cleaning up your fixed assets and rental assets. Today we're going to be talking about liabilities. Okay, so first of all, what is a liability? I'm sure you all know what a liability is. It's a debt or obligation to pay a certain amount of money to a creditor or anyone who loaned you money. Now, liabilities are recorded at different times depending on what accounting method you're using. Some companies use the cash method, some people use the accrual method. Basically, the cash basis of accounting only records revenues and expenses and transactions when a cash transfer actually happens. Now, the accrual basis looks at the true substance of a transaction. When you actually incurred a cost or when you actually earned the revenue, that's when these are recorded. And that's true about loans. When you sign the loan document to the bank, you're legally obligated to pay them. Thus, you incur a liability, and it's recorded on your books. Now that we know when to record these liabilities, let's check out the current liabilities. Now, these are short-term debts that are due in the next 12 months. These typically include accounts payable, floor plan payable, credit cards, taxes, anything like that that's due in the next 12 months. Let's take a look at each of these, starting with accounts payable. I'm sure you all know what accounts payable is. It's a trade debt that has to be paid within a year. In other words, this is a short-term debt to vendors, suppliers, so all your payments on account to places like Fender, Gibson, Yamaha, Melbay, all these places are trade debts that go in your AP. So at the end of the year, go through your AP aging report, look at your vendor list, and make sure all the vendors that you owe money are listed in there. Also, look to make sure there aren't any bad balances in there. The one thing that you have to look out for is that you don't put any debt that matures in longer than 1 year in AP. The main example of this is floor planning. This is a way to finance your inventory as you sell it. Another current liability is credit cards. Now, these are slightly different because these are recorded on your balance sheet as a liability at the time it's charged on your card. The main thing to look at for your year-end credit cards is to make sure you go through the charges that occur late in the month and at the end of the year, and make sure that everything is included. The last current liability are accrued expenses. These are things that you incurred during the year but don't actually pay during the year. For example, your last month's sales tax that's actually paid in the first month of the next year. So if you're using the accrual basis of accounting, go back and look at your sales tax, your payroll taxes, your payroll, and look at all the expenses that happened the last month of the year that you actually paid in the following year. Those will need to be recorded as current liabilities. The next liability we're going to talk about are bank debts. Now, there's two main kinds of bank debts. The first is a line of credit. This is a short-term loan from a bank that can be used for inventory or financing any kind of short-term assets. Now, the other type of bank loan is long-term debt. Now, these are any loans that mature in greater than 1 year. In other words, you have more than 1 year to pay off the principal of these notes. These are generally used to finance long-term assets, so building improvements, fixed assets, and any other asset that will give you benefits for future years. The last type of loan is an owner or officer loan. Now, this is the amount of money that the owner of the store, the officer of a store, has put into the store and is going to be repaid. A couple things about this. First thing, there should always be an actual physical agreement or loan document between the officer and the company, just like if you got a regular bank loan. Also, the company should pay interest on this loan to the officer, just like they pay interest on a bank loan to a bank. Now, if the company does pay interest to the officer, the company should issue a 1099 interest or 1099 INT each year to the officer. Now, in the financial statements, the officer loan should always be stated separately than any of the bank loans or short-term debt because they're related party debts. Well, that was all the different types of liabilities. Let's move on to talk about why it's important to state them correctly on your financial statements. The first main reason is suppliers and vendors. These types of creditors look at your current balances to determine how much they're willing to lend you in the future. In other words, if you have large balances, they're probably less likely to keep extending more credit to you. The second main reason is banks use your financial statements to evaluate how well you can cover new debt. They call this the debt service coverage ratio. So basically it shows how well you can afford to pay your interest and principal payment. The last main reason is internal analysis. How are you going to know what you can afford and what you can't afford if you don't even have a good understanding of your current debt load and the current cost of interest? You can't. That's why it's so important that you record these properly. Now that we've covered liabilities and what to look for at year end, feel free to go back and review our last 3 videos about cleaning up your current and long-term assets. Stay tuned for our next video where we'll be talking about equity and how the income statement affects the balance sheet. We'll see you guys next time.